Hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. Well, listen, I want to apologize for not putting out a video last week. I was sick, and as you can hear by my voice, I'm still getting over it. But I wanted to go ahead and make a video this week. The market selling is picking up, and wanted to come in and talk a little bit about it. Because what we know, one of the things we know is that anytime you have an important high and a move up or down, let's say an important high or low and a move up or down from that high or low, with the correction following, that next move can be quite significant. And so I want to cover that principle here. So I've got a chart of the S&P 500. I'm going to take the MACDs down here, and we've talked about this divergence several different times, so I'm not going to spend a bunch of time talking about that today, given that my voice is likely to go out here during the conversation. But what I want to talk about is I want to zoom in here on this topping action, and I want to talk about how the market ran up, made a high, pulled back, and then started to run up again. So this is an important pivot here, okay? So what we want to do is, what we know is the market tends to go from pivot to pivot. So what we would do is we would create a decision point off of that pivot just above that pivot area. And it's completely arbitrary, but in hindsight, it's easy to draw here, but it's just as easy to draw if, say, you were looking at the market right here. There's no difference. I mean, it just helps you decide, what kind of positions you should have on. Should you have bullish positions? If you're right here at, say, 28.25 and in an uptrend, okay, and resistance is here, should you have bullish trades on right here? Well, if you have bullish trades on, you can keep them on, but you wouldn't want to initiate new bullish trades here. You'd want to wait till it got into this area and then made some sort of decision, right? Either decision to go through or a decision to roll over and go the other way. That's why we call them decision points. It's not my term. It's something that a guy named Steve Griffiths uses in his model. And we've talked about that model here. I have a cough drop in my mouth, by the way, too, to keep me from coughing. So I just apologize in general for my voice if I cough or anything like that happens. It's just the nature of getting over, one of these things we have here in Texas. So anyway, we've got our decision point here, so that when we go back out, when we scan, when we go back out, we can kind of we're expecting the market to do something here, either chop around here a little bit and then go through this, or chop around a little bit and then roll over. And of course, it rolled over. So this now is an important high. Okay, this is a new high off of this pivot, and it's off of this weekly chart. So it's higher time frame support high or resistance. And so then the market made a move down. So now I'm going to switch real quick to a daily candles. So now we can see that the market moved down right here. Let me zoom in a little bit. Well, that may be too much. Let me zoom back out and just zoom in from here. Okay, so the market made this initial move down right here, right? And it appears to the move back up appears to be a correction. Now, what makes it a correction? Why would we call it a correction? Well, first of all, we made a high, but not a higher high. Okay, we came down and made a low, but not a lower low, and then we rallied back up and made a high, but not a higher high. So this is very what we call overlapping. And when you have very overlapping price action, it's usually indicative of a correction. Now, technically, you can't say this is a correction until we break these lows down here, this low right here. But I can just tell you that this is classic what Steve Griffiths teaches is a holy grail trade. You know, market moves down, moves back in a correction. Of course, what he would do is he would be taking his trade right here, and his target would be, I'm not even sure I can fit his target down here. We'd have to zoom out a little bit to show you where his target would be. Let me go back to a weekly. I'll show you where his target could be. And well, it's just down here where this blue box is. So we're talking about the market moving a long way here in a wave 3. Probably move down here to these lows, maybe just shy of these lows, around 1850, rally a little bit, and then come back and break all the way down through to this blue box. So let me see if I can zoom out. Well, I can't zoom out any more than that. Let's do a 10-year. Okay. Now you can begin to see, I'll put it back on a weekly though. You can begin to see, well, yeah, you can begin to see this blue box down here around 1700. So obviously, you know, if you've got a 401k or an IRA, you really can't short the market. So you just, the best place to be here is just in cash when this is making this move. And then when we get down here to this decision point area, you can actually enter back into the market for a good pop back up, probably to the underside of this channel when that time comes. So, but obviously, you know, who wants to lose this money, right? So I don't know what that is, but you know, let's say from here, let's just say from where it is right now, to this blue box that's about 35% loss. So, you know, who wants that, right? So just be aware of this principle. Again, the principle is, if I have an important high or low, let's maybe look at right here. This is a good example. Okay. So if you were to go back, let's go back a little further. If you go back to this low and you said, okay, here's an important low and I want to create a decision point off of it. So you just come below those prices. Of course, I'm not going to be able to put it all the way over there, but I'll cheat and move it here. So you can see here that price came into this decision point, and then you can see here that it rallied up, and then it came back to a higher low. Now this is where things are really important. So this is a low, a rally up, the first move up, and then a pullback. And this is not as overlapping, but it's a pullback nonetheless. So the question is, okay, where's the market likely to go to? And another good way to do this, especially if you don't have any price action above that you can draw a pivot off of, is you can come back from the high price back to the low, and then you go to this 2.618 area. This is very, very typical of markets. You'll see this 2.618 happen all the time on this high or low situation. So let's look and see where that is. Zoom in here. So that 2.618 was right here. So see, the market went to at least here before it's pulled back, right? Actually pulled a little bit back here, but then it pulled back again here, maybe a little deeper. So, you know, you could have traded to the 2.618, or you could have said, I'm going to have bullish trades on until I get to this 2.618. And then look here, we have another pullback, right? So we have a kind of an ABC pullback, again to a higher low. So you could have found the first move off of this and then just done the whole thing over again. So this method works really, really well. And the reason that second move off the bottom or top is so substantial is because people are usually positioned in this case for a bounce, right? So what people see here is they see the market made new highs and then pulled back, and they're looking for a bounce in a new trend, but the trend is, in this case, is over. So what happens when the trend is over? You get some sort of correction. So that's where we are right now. I hope that's not too confusing. I hope it makes sense. You can use this principle in any market. We can show it to you in any market, but it works. It works in Forex, works in futures, it works in all kinds of different markets. In fact, if we were to look at some charts, you would see this pattern over and over and over and over again. So, all right, hope that helps. All right, let's look at. Let me find my my program here. Let's see. Let's look at volatility. Volatility is something you've been hearing a lot about in the news. Back on a 5-year chart, and as you might expect, volatility, jumped up, kind of consolidated, and just jumped up again. So, we're in an area, we're in a time frame of expanding volatility, and I would just expect volatility to continue to expand. Now, unless you're selling options or buying options, volatility, what it really means for the average person in the 401k or IRA space is that that selling is likely to pick up. Okay, so what happens is the world is basically what we call long. Okay, the world's basically bullish on most markets. And then what happens when you get a correction, because people are losing money and they're trying to adjust their portfolios, things like option prices get more expensive, and that shows itself as volatility. Volatility is just a derivative of a derivative of option prices. So, long story short is it's related to selling. So volatility picks up when selling picks up. Okay. All right. We can look at Treasury yield. You're hearing a lot about the Fed. The Fed. Maybe the Fed's through raising rates, so on and so forth. Well, here's what I can promise you. If this 10-year Treasury, when it starts to really move up, the Fed's going to raise rates. There's no way they're going to let these interest rates take off without them. It's just not going to happen. And so we've talked about this before. In fact, we were talking about it here that interest rates might pull back into this area. And that's still a likely pullback target, and potentially even lower than that, maybe in this 2.2 area. Although I think this 2.5 area is probably a pretty good spot, because basically this looks like the fourth wave low right here, and at least of this particular degree. And so it's very plausible to me that interest rates, the 10-year, would pull back into this area around 2.6, 2.5, and then start to shoot up again. And when they shoot up, and when I'm talking about shoot up, I'm talking about take out these highs and really start accelerating to the upside. The Fed will begin to raise that short-term interest rate. It doesn't matter what the economy does. If it starts to wreck the economy, they don't care. They're more concerned about their reputation and saving face. And if interest rates really start to go up, but the Fed's not raising rates, people are going to wonder why. Why are interest rates going up? The Fed's not raising rates. And they're going to start to lose some of the mystique and the prestige they have, and they can't have that. So if this 10-year, you see this 10-year take off to the upside, you can bet your bottom dollar the Fed's going to keep raising rates. All right. Okay. Let's look at some of these other countries. I think Germany's clearly, in a downtrend. We talked about this and how it would probably accelerate if it got outside this, and I think you're going to see Germany accelerate downward from here. Japan is still in here, although this looks a lot like in kind of a 1, 2, 1, and then 2. When this 2 is over with, this should accelerate to the downside. The UK, I don't know, the UK. I mean, it looks the same, so we have to kind of respect that. But the UK's got some things that are going on that are very political and could really whip this trend around a lot. You know, with this Brexit, potentially a hard Brexit with Europe, and there could be a lot of emotion in this market in the coming weeks and months. And so, you know, I don't know. If I were in the UK and I had my IRA or 401k in the FTSE 100 or something like that, I probably would just already have it out sitting on the sidelines. That's one of your biggest advantages as a retail trader or retail investor. Retail just meaning, you know, you got less than $10 million or something. You know, people that have less really even than $100 million are considered small fish in the investing world. So, you know, the bottom line is you should use that to your advantage. And sometimes just stepping off on the sidelines and going to cash is the best way to do that. All right. See if there's anything else over here that I wanted to look at. No, I think, well, let's go ahead and go over to toss charts. And right here I have the euro. And so the euro, you know, was in this downtrend, kind of an A, B, C, with C kind of working out as doing 1, 2, 3, 4, 5. And then we've got this move off the bottom, some sort of correction that may or may not be over. But I think we're at a place where the euro is probably considered to be bullish and would at least make a move up into this 1.19 area. Maybe just shy of that. You know, in case it's bearish, you might want to stay underneath the 1.18 area to take profits. But I think the euro is a good place here. You got a series of higher lows here. It's kind of coiling up, and a lot of times that will break out to the upside. Let's see. Let's look at oil. Oil's just been in a nosedive, and of course you're hearing a lot about OPEC and this kind of thing, and you know, really none of this really matters. I mean, oil is largely a financial investment, and so therefore it trades. Even though it's a commodity, it trades very much like a financial investment. So oil's in a pretty steep downtrend here, and you know, it just remains to be seen whether or not this is going to be kind of an A, B, C, you know, in a triangle, sideways triangle, as it develops out this way, or if, you know, this pullback's going to be sharper, or if this is the counter trend move, and now we're, you know, going to experience 5 ways down here. But I would say I wouldn't be long oil, but you know, if you're going to be short, you might wait for a bounce back up into this area and then try to short it down in here to this this DP area below 40. Or just don't buy stocks, don't buy oil stocks until you get down here around 40, and then look to buy oil stocks. All right. I guess we can look at gold. Gold and silver both look like they're trying to bottom out. They're very difficult charts right now to read. There's just a lot of chop and so on and so forth, but it's plausible to have gold get up here around 1500. We got a gap over here on the chart that's likely to be closed in this rally. And just in general, gold has been bearish for a long time, and it's starting to look bullish. The sentiment indicators are also very bullish. Same thing can be said about silver, although silver chopped around here close to the bottom for a lot longer. So one of the things I want to look at this week, because we haven't talked about it in a long time, is Bitcoin. Bitcoin, I just lost the chart. A lot of talk about Bitcoin going to the moon or whatever, and it got up here around almost $19,000 a coin, and then entered into the bear market. And of course, you can see it made this little descending triangle shelf. I'm assuming you can see this here. Let's draw it. You can see this kind of, well, this is what we call a descending triangle. And then once it breaks out of the triangle, then it's got more downside. And so the actual math may not work out because it's actually pretty low here. But if you look at the descending triangle, it's about 12.5 here, and it's about, let's just call it 6 here. So that's 5,500. Once it breaks out. So that tells me Bitcoin is probably going to zero eventually. So just be careful with Bitcoin. Don't be trying to buy it all the way down to the bottom. You can buy a bounce if you want. You can do anything you want, actually. It's your money, but just be careful trying to catch this falling knife. I think Bitcoin's done, and likely not going to see it back anywhere near its highs. Now, the other thing that I wanted to point out, there's a lot of everybody's got older people in their family, and over the last couple of years there was kind of a mad rush into high yield, and I just want to show how dangerous this can be. This is the Bloomberg Barclays U.S. corporate high yield spread, and we're at a 2-year extreme low on the yield. So what this means is that these people that went into these high yield products are gonna lose. They're gonna get wiped out. They're gonna lose all their money. So just if you got older people in your family, just make sure that they know in this rising interest rate environment, bonds are not safe. Okay, I mean, if you went out and bought a 90-day bond and just rolled it over every 90 days, that's probably an okay strategy, because technically the next 90 days would be worth more than the previous, and so on and so forth. Just keep going out. But I don't know, this bond market's going to trap a lot of people, and it's going to be kind of sad because a lot of them are older people and they need the income, and so they were drawn into this higher yield space thinking that bonds aren't risky, and we just happen to be at the end of a 35-year bond bull market. So anytime you're at the end of a long trend like that, a lot of people get caught up in the dangers of those types of owning those types of assets. All right, so let's go back to the S&P 500 and just look again. Our target's going to be down here around 1,800. So we got quite a ways to go, but somewhere in here you'll start to see this really pick up, be some big gaps on the chart, and you'll start hearing about how the S&P's down, 100 or 200 points in one day, that kind of thing. So again, just better to step off the track, let the train just roar on by, and wait for sunnier days to go get gains in the markets. Okay. All right, everybody, I'm going to go ahead and check out here because my voice is failing quickly. But I did want to get a video out today. Thanks for coming in, and feel free to send these videos to your friends and family to help keep them out of trouble. All right. Thanks a lot, and we'll talk to you next week. Bye-bye.